Thank you, Mr. Chairman, and I appreciate the panel taking time out of their day to provide testimony to the committee. I've been working on legislation with the gentleman from Delaware, Mr. Carney, that would establish a pilot program that would allow emerging growth companies to trade at 5 and 10 cent increments. Why? Well, we all know that America's #1 job creators, our small businesses, still need help. Congress put aside partisan differences last year and passed the Jobs Act, which removed a number of barriers to raising capital to start a business. It's only logical that the next step is to help improve the liquidity of emerging growth companies once public. This is the main purpose of our proposal. It is no secret that the number of U.S.-listed IPOs raising less than $50 million has declined since the 1990s. Then there were typically more than 100 such IPOs. Last year, there were less than 10. Further, when the SEC implemented decimalization, larger companies saw an influx of investors, while our smaller companies saw their liquidity decrease. I believe that this issue can be partially remedied through reforms to our tick sizes for our small cap companies. I'll look forward to all of your comments on how we could create better liquidity with increasing our tick sizes. And with that, Mr. Chairman, I yield back. Thank you, Mr. Chairman. And again, I appreciate all of the conversation around tick sizes and maybe the benefits or drawbacks that you guys all have provided your opinions on. First, I want to thank Mr. Quadman for bringing up the issue of a safe harbor. I think that's a good point. If we're going to have a successful tick size pilot program, we want to make sure there's no liability. And I think that's a conversation we want to pursue, but I appreciate you bringing that point up. And I want to be clear, we don't have any interest, I'm not trying to engage in the larger argument between our dark pools and exchanges, and I think we've entered into a space that has got some people excited. We truly are trying to create more liquidity for our small cap companies. I mean, that's the true intent here. And I know that people are looking down the road and might take some signaling of our proposal that we're trying to have a greater impact on the market structure, and that's not the intent. But maybe to Mr. Wunderlich, if we allow just a quote at, aren't we really undermining the purpose of a tick size bill? I mean, don't we don't get the full impact of this experiment, this pilot program?
So, yes and no, in that it does seem sort of counterintuitive, right? That you're going to quote it in nickels and dimes, and then you're going to trade it maybe in between.
Can you pull your mic up a little bit?
Oh, sorry. But so maybe it does seem a little counterintuitive, but the issue is it's sort of I guess if I want to go back point in history, when we traded in 8ths and 16ths, I mean, we always traded in between the bid and the ask. It's been done historically, and I think liquidity, in our experience, was a lot better before decimalization in small and mid-cap stocks. Not necessarily the case in larger cap stocks. The other issue is, you from where I sit from a market making standpoint, we do think that it's taking more risk if you're committing to basically having to trade in larger increments. And the other side is just sort of market valuation and efficiency. I mean, liquid markets, are very efficient over time, and as far as where things should or shouldn't be priced. And I don't want to say it's manipulation or price fixing, but in a sense you kind of are if you're mandating you've got to be at this dime or this nickel or 20 cents. That being said, I mean, I will reiterate we are for the pilot again, but we think we ought to be able to trade between the bid and the ask.
And we're creating a financial incentive here, aren't we? I mean, that's the purpose.
I'm sorry, I didn't hear you.
We're trying to create a financial incentive here.
That's
for
correct.
Market makers, and that incentive may be diminished if we allow more price improvement trading between the ticks. Yes?
No, sir. I think I would go the other way, and the incentive is for whom, right? Is it for the investor? Is it for the brokerage firm? Is it for the issuer? I mean, there's several constituents involved, and one is for us to have an incentive to even traffic in these stocks. If we view that they're an outsized business risk, where we're mandated to have to take a price, then we're less likely to commit capital to something like that than if we were able to trade freely between the bid and the offer.
Yeah. Mr. Wild?
Did I answer your question?
Kind of. Maybe we can talk about it a little more later. Mr. Wild, I mean, do you agree with that? Do you think we diminish the pilot program, our tick size pilot program, if we allow trading between the ticks?
Well, I think we do on the margin. I think that everything. Step back for a second and look at the study that we did on the 26 foreign IPO markets, the 26 largest, and we have a convention in this country where we don't allow, most brokerage firms don't allow brokers to solicit stocks or put them on margin if they're under $5 a share, so it arbitrarily keeps our stock prices high. So the United States has 0% stocks that have a 1% or higher tick size that are sub 500 million, that are microcap or smaller. Whereas the high IPO producing countries, which are countries like Singapore, Australia, Canada, weighted for GDP, 70% or more of their microcap stocks have 1% or higher tick sizes, because they split the stocks down to levels where a penny, if at 50 cents, a penny can make 2% difference incentive. So I think we've got to, I do believe that a nickel or a dime and having some integrity to the tick size will ultimately cause the market to compete on providing sales, capital, value support, and it won't let the market compete on price, which is the problem in microcap markets. I totally agree with the point of view. I think Tom said this earlier. Large cap stocks that are innately liquid stocks actually become more liquid with smaller tick sizes, but the academic literature clearly shows that innately illiquid stocks become less liquid with smaller tick sizes. So the reverse of that, which is increase the tick and respect the tick size, will bring liquidity to these stocks.
And Mr. Wunderlich, do you agree with that? Okay.
Yes, I do. Sorry.
Thank you. I yield back.